Hey, it's Angela and Michele with the Hatch Homes Group, the Hatch Sisters. Thanks for tuning in.
Yeah, so there's a major update in the mortgage world right now. Fannie Mae is officially dropping its minimum 620 credit score requirement for loan eligibility.
This is a big deal for buyers on the edge of qualifying, but it also comes with some misconceptions, as things do. Today, we're breaking down what the change actually means, how Desktop Underwriter works, and the pros and cons you need to understand.
Starting this week, borrowers will no longer need a 620 middle credit score to be evaluated through Fannie Mae's system.
Yeah. So that means someone with like a 619 or possibly lower credit score who used to be automatically disqualified can now be reviewed like any other borrower.
But, and we'll talk about this later, that does not mean every low score borrower will get approved.
Very good distinction there. There were two driving reasons behind this update. So first, to make homeownership more accessible for buyers with little or non-traditional credit histories.
And second, research has shown traditional credit scoring can have discriminatory impacts. Removing the hard cutoff helps level the playing field for otherwise qualified buyers. To understand this change, you need to know about Desktop Underwriter, or we call it DU.
DU is Fannie Mae's automated underwriting system. It analyzes your entire financial picture and gives a recommendation based on risk. It gives an approve, eligible, or refer. Basically, it's the software.
And here's the important part. DU does not use credit scores to determine risk. It looks at reserves, debt load, payment history patterns, job and income stability, big one, loan purpose, and property type.
Yeah, so the old 620 cutoff wasn't part of the DU's risk model. It simply blocked some buyers from even being reviewed as soon as it saw the score was less than 620, which is why Fannie Mae removed it.
Which I think is a big distinction here.
Yeah.
So, does this mean low scores are now automatically approved? No. A low credit score doesn't automatically mean DU will approve you.
DU still requires strong overall financial health, which is a good thing. If your debt is too high or you've had some recent late payments, DU can still deny the loan.
Are mortgage insurance companies going to follow the same rules?
I mean, there are some changes happening with mortgage insurance companies. And the biggest one is that they're allowing blended scores.
This is actually pretty awesome in my opinion. Every time I've bought a property, they use the lower of the two credit scores between my husband and I. It's always created a friendly competition between me and my spouse, but it's also been really annoying that we can't use the higher of the two scores. So, blending that's a compromise.
Absolutely. And it kind of goes for an individual too. When they use the lower one, now they can just use an average. I mean, not every PMI company has adopted this yet, but this is an important step. And now, let's break down the pros and cons of this change.
Pro number 1, access to home ownership is very important. And if we want to help the American people have financial security, being a homeowner is a huge step towards that. So more borrowers will have access, especially those stuck at 618, 619. They can now get reviewed instead of being automatically shut out.
That's so great. Pro number 2. DU looks at the entire financial picture, not just the score. And that's a more fairer, realistic way to judge creditworthiness. This makes me think of a lot of people I know who do not want to have a credit card or lines of credit to worry about. Or how about people who are new to this country and have not established credit here, but do have the means and the cash to do it? This is an important step.
Pro number 3. Traditional credit scoring has documented inequities. This change brings more fairness and equal access to the process.
Absolutely.
Now, some cons to consider. 1, the cost. Eliminating the 620 floor does not eliminate the cost of having a low score. Your interest rate is based off your credit score, so a low score will still push on affordability. And I mean, let's look at 0% down loans. They're expensive. I don't expect any differences here.
Agreed. Con number 2, We have historically low inventory, meaning we do not have enough homes to meet the number of buyers in demand. So if we have more buyers in the market, that could potentially make inventory even lower, therefore increasing prices and, inflation.
Con number 3, some people can go straight to the fact that the low lending regulations did not bode well for us when the market crashed in 2007 bubble.
Yeah.
This is something to look at. A borrower that can't afford a house can easily lose it when the market turns. But a huge but, there will be checks and balances to protect a borrower from getting in over their head, very unlike the last loose regulation market.
Yeah. Con number 4. Lenders can still impose their own regulations or cautionary approvals. So even though Fannie Mae doesn't require the 620 credit score, your lender might. This may not actually be a con, however, because it can be confusing for a borrower. So having a good lender by your side is imperative. You don't want an online lender to do a quick pre-qualification and then find out you don't qualify once you find your dream house. That's sad.
It is. It is sad.
Bottom line, this change doesn't lower lending standards. It simply removes an outdated barrier and allows more qualified buyers a real chance at home ownership, which in turn provides security and generational wealth in America.
If you want to know how these new guidelines apply to your situation, call, text, email, or click on the link below to set up a no-obligation consultation with us.
Yeah, we'll hook you up. See you next week, and thank you so much for tuning in. Like and subscribe. Okay, how do you think that went, Mike?
Can you give it a sec? Because Angela loves a blooper.
I won't give you a blooper.
Hey,
Okay.
honestly,
Basically, it's just software. I need to do that.
we'll just do that again. Yeah, let's try.
Hi, you've had recent late payments, or you can... I didn't do that.